It's widely understood that property prices are on the rise again, even while interest rates continue to increase and borrowing capacities subsequently fall. These conditions hit first home buyers the hardest, which is probably a major contributor to why the Bank of Mum and Dad is the fifth largest lender in this country. And from a societal perspective, this will continue to drive a wedge between the haves and the have-nots. For those first home buyers fortunate enough to have parents wealthy enough to help them, great. For the rest, this divide will exacerbate generational disadvantage. But from a business perspective, what opportunities does this offer for the development of different lending products?
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
Today's guest has moved from a conventional banking career into the world of startups and fintech, and we're keen to understand how innovation is playing out in the lending space. Brian Hartzer spent 15 years in senior executive roles at major banks in Australia and the UK, and these included being CEO at Westpac and divisional chief executive roles at the Royal Bank of Scotland and ANZ. And he is now the chairman of 2B, a Sydney startup home equity lender for over 55s, as well as Beforepay, a fintech startup, and Reejig, an HR technology startup. And he's also a senior advisor to Quantium, which is a Sydney-based data science company and another private mortgage lender. He's also an angel investor in and an advisor to several fintech and technology startups. This is all a bit of a tongue twister, but what I'm trying to show you, he's got quite a pedigree. And we're really impressed that you decided to join us today, Brian. And this is a great conversation, I think, very timely in terms of what's happening in the property market with affordability, et cetera, et cetera. So thanks for joining us, and we're looking forward to this chat.
Thanks for having me. Nice to be here.
Brian, obviously we've met before and we've had a bit of a chat around the 2B and the story, but we've done 250 odd episodes now on this podcast, and we haven't really delved deep into the Bank of Mum and Dad, really. And it's been a huge player in the property market. We do a lot with the sort of first home buyers, and, you can really see, a big majority are sort of getting help from somewhere, whether it's early inheritances or gifts, etc. So just enlighten us, I guess, and our listeners on, how big the Bank of Mum and Dad is, and, and potentially how big it could be, I guess, if they had access to more money.
Yeah, well, I think it is already a very big lender. I think you cited that at the start of the podcast, that this has become a huge feature of the property market. And for better or worse, certainly for people who are trying to get on the property ladder, given what's happened to house prices over the last, pick a number, 10 years, 15 years, it's really difficult for people to get going if they haven't got a bit of help from the parents who've built up equity in their homes. And there's another big demographic aspect here, which is just the aging of the baby boomers means that you've got 5.5 million people who have been, many of them paying mortgages. A lot of them have paid them off now. I think our numbers are there's about 1.8 million people in that demographic who have paid off their home completely and are now, by definition, having kids who are in that first home buyer range. And so looking to find ways to help them out. The ones who've got lots of excess liquidity obviously are in a good position, but the ones who maybe have their assets tied up in homes or investment properties don't necessarily have the cash to help. And that's been the particular issue that we decided to try to assist them with.
Yeah, so there's a huge gap in the market, right? There's not really, which we'll talk about later, is like reverse home loans. There's not really many options for people over the age of, getting close to retirement or retired, right? There's a huge gap in bank policy that exists.
Yeah, so one of the big things that's happened over the last 10 years is what I think of as overregulation, well-intended, but a desire under the rubric of responsible lending. The focus of banks' credit policies with the encouragement of ASIC has been to really focus on serviceability and free cash flow as a way to pay off a loan, and not focusing on the asset backing that someone has. And we think in an environment where many people's primary asset is their home or the investment properties that they own, that it's not really right from it's certainly not economic, and it doesn't make sense from a society point of view to not give people an opportunity to borrow against those properties. And as you and I have talked about, Chris, there are lenders out there who, if you have the right connections, if you work really hard at it, will eventually find a way to give you a solution that lets you borrow against assets, but it's difficult. And actually, the main focus for many lenders is really people who have a salaried income and can pay off the loan over the term of that loan. And obviously, if you're getting to 55, 60, 65, and you're approaching retirement, your ability to say, yes, I'm going to have this free cash flow for the next 5, 10, 15 years is getting more difficult. And so we think that's opened up a big gap in the market where everyone's busy fighting over upgraders and first home buyers, and no one's really paying attention to a very significant portion of the population who have a lot of value in the equity in their homes.
This is actually quite interesting for a lot of reasons. One is because I just turned 55. So
welcome to the club.
All of a sudden, I'm in the group.
Sneaks up on you quickly. It sneaks up on you quickly,
sure
doesn't
does.
it?
If anyone's out there in their 20s and 30s thinking, Jesus, she's old. Well, let me tell you, I used to think that only yesterday. Now, and I look at my situation now and I think to myself, if I wanted to borrow money, then the bank's not going to want to give me a 30-year mortgage. And then that makes me 85 at the end of it. And I have to have exit strategies and all this sort of stuff. And yet I've got a huge amount of equity. And if I want to slow down and earn less and slow down a little bit and enjoy the benefit of all the hard work I've done, but also the investments that I've made over time, then my options are actually limited in some regards if I don't want to sell something. So I guess what would be really interesting for you to run through, so it's not just helping your kids, get into the property market. I would imagine there's a lot of reasons that somebody over 55 might want to borrow without necessarily selling down an asset in order to access some funds. Can you run through some of the scenarios that you could see, that you're solving here for?
Yeah, that's quite right. By the way, the reason we called the business To Be is it comes from the idea of to be or not to be, and the idea that if you're in this stage of life, now is the time to be. Now is the time to be enjoying what you've built up and take advantage of that position that you've gotten yourself to. And so the Bank of Mom and Dad opportunity with first home buyers was the first thing that jumped out of the research that we did as being something that really resonated with people. But we're also seeing interest in funding holidays, readjusting investment portfolios, just having a bit of extra cash to renovate. In particular, renovation is a big one. Buying a lifestyle asset, a boat, an RV, those sorts of things. And also, to an extent, looking at diversifying their investments. So perhaps they want to have a bit more money in their super rather than just in tied up in property. If they have a view on where the markets are going there, those are the main ones. I might think of one or two others as we go.
So would somebody borrow potentially if they're looking at a sort of a shorter runway in terms of their earning capacity? Would they borrow enough to then include a buffer? Would that be something that would be envisaged there so that they don't have to really worry about the earnings, particularly if they're borrowing to invest? Say they're borrowing to put mum money in their super, for argument's sake. Is that something that's possible in terms of the solutions that you're offering?
Yeah, so the way it works for us is you're borrowing purely based on the asset value and your credit history. And you can borrow an amount that's linked to your age and the value of your property. So essentially, the loan to value ratio that you can draw down on depends on how old you are. So for us at 55, you can borrow 15% of the value of your property up to 35% if you're 75. So it increases 1% a year. And we don't mind what people use the money for. We do ask, and we describe it as any legitimate purpose. So if you told us you were going to gamble it, we'd probably say no. But as long as it's a reasonable use, it does give you access to that money. And our loan is structured as a 5-year loan with the option of capitalizing interest. So if someone is looking to buy an asset or lend money to their kids, they have the ability to draw down on that equity, choose to capitalize interest, and then pay it all back at the end of 5 years when perhaps at that time they're planning to downsize or sell an asset, or maybe their kids are going to pay them back by refinancing, those sorts of things.
Yeah, and I'd be interested to talk, Brian, about there's not many options, right? Because I think you were working at Westpac when you shut down reverse mortgages, right? Like, it wasn't a big profit-making exercise for the risk versus the reward, I guess, in the banks. And so it's a real gap in the marketplace. People think, obviously, there's access to reverse mortgages is really easy, but it just doesn't. It's not really like that's how it works in Australia.
No, that's right. Actually, the reverse mortgage industry in Australia has shrunk quite dramatically. And as you say, there is a certain irony in this, which is it was my decision to shut reverse mortgages down at Westpac, at ANZ, and at RBS when I was in the UK. And the reason that I did that was not because I didn't believe in the product or believe in the demand, but because from the perspective of a large branded bank, the compliance and PR and legal challenges around traditional reverse mortgages just became more trouble than they were worth, is in simple terms. And there were just examples where, with all good intentions, people had done a reverse mortgage, and then 10, 15 years later, the customer has become infirm, and typically it was the kids would come along and say, wait a minute, you've taken advantage of my parents. And even though it was all legitimate at the time, it just became a bit of a nightmare. And large banks have to focus their exercises. They're all going through simplification and the like. And so we made that decision, but it bothered me at the time because I thought this is actually a societal need. And it was one of the reasons why we went back to it after I left Westpac, of thinking, hang on, I know there is this gap in the market there to go after. I think the other thing to say about, and as a consequence of that, there are only probably 5 or 6 providers of reverse mortgages left in Australia, of which technically we are one, although our product works a bit differently than most reverse mortgages. The other subtlety is most reverse mortgage players we talk about it internally as people who need the money as opposed to people who want the money. And so it's people who only own their home, don't have a lot of other assets, and therefore their only way to stay in their home is to get a reverse mortgage. We're targeting a more affluent segment of customers who actually do have other assets. They could sell those assets, but they don't want to. They are more sophisticated. They're looking for a solution that provides them some liquidity for a period of time. You can almost think of it as a bit of a bridging loan towards some other thing that they're planning to do in the future.
So a couple of questions. Can you just briefly explain how a reverse mortgage works? And then I'm curious to know what the sort of, what's the difference in interest rates, for argument's sake? Like, obviously there's more risk, I guess, potentially to you guys than, in the typical banking model, perhaps. So it'd be interesting to know, I guess, how you price that. But yeah, do you want to explain? It's a long time since I've spoken to anybody about a reverse mortgage, so I can't remember.
Yeah, sure. So a reverse mortgage, essentially, it's a first mortgage. So there's a first lien on a property. And in a typical reverse mortgage, an amount is advanced either as a lump sum, or as you can think of it kind of as an annuity of an amount being advanced every month or the like. And the balance, the interest is capitalized so that the amount of the loan rises over time as a function of that interest. And typically there's an agreement that the loan is payable when you sell the property or go into permanent care for an elderly person. And at that point in time, the property is sold, the loan is repaid, and the remaining equity goes to the client. So that's the typical solution. And it's typically been for people who are, as I say, only owning their home, don't have cash flow, need some extra support there.
And is there usually a difference in interest rates? Like, would they be at sort of commercial rates?
Yeah, they're typically a couple of percentage points higher than a mortgage rate. So our rate at the moment, I think, is a variable rate is 8.2%, which is obviously a couple of percentage points above a typical mortgage rate. part of the reason for that is that there's a bit of extra risk because you're not doing the serviceability calculation, but in particular, the ability to capitalize interest means that the people who are funding the loan are deferring that payment for a longer period of time, and that obviously brings with it certain risks. There's also more compliance and conduct work that you need to do for a reverse mortgage than for a conventional mortgage to make sure that you're not lending to people who are vulnerable or are, you got to be aware of. We spent a lot of time looking at issues like elder abuse, all those sorts of things that you need to watch out for. And so that makes the process of approving one of these loans a lot more costly. But the flip side is the availability and the ability to rely purely on the asset value.
Brian, do you see, back in your bank days, CEO, talking to APRA, talking to the institution, I guess, and the thoughts like, around responsible lending, do you see the banks doing a reverse and going back into reverse mortgages? Like, there is a margin, let's say it's 2 or 3% because of competition, but if there was a relaxation to responsible lending and you could lend on assets rather than income, do you see that is something that they're willing to do, or is it really that door's not going to be open for a long time based on your discussions you've had?
I think that door's closed for a fairly long time. And now it may be that some of the banks from an institutional point of view through their securitization programs may provide some funding to that sector. But there's just been so much challenge around the consistency of compliance for these sort of products. The experience of the Royal Commission has scarred the banks pretty significantly. The regulators are very concerned about anything that could lead to reputational risk for the bank. And one of the consequences, one of the technical subtleties here is that for a bank, these are considered non-standard mortgages, and so they have a higher capital requirement relative to a traditional mortgage. And so ultimately, the logical funders of these loans are more like pension funds and insurance companies than banks, because the capital treatment is a bit different. So I personally think between the compliance team, the credit risk team, the PR and media team, the government affairs team, the strategy teams within the big banks, there are a whole lot of antibodies that would fight a suggestion of getting back into reverse mortgages. I think they generally view it as a lot of potential downside for not a lot of upside. And so that's been part of our thinking around this, is that realistically there is a gap in the market, which, by the way, they acknowledge. I've still got friends at a number of the big banks, and they say, yeah, this is a great idea and we'll never do it. And which it was pretty encouraging to us when we were setting up the business.
Well, another big lender is probably going to be the super funds, right? Like, you can see that they're now moving more and more into residential with build to rent projects, etc. Do you see that, a long-term annual, set sort of annuity stream is good for super funds, right? That aligns to their members. Do you see them becoming big players in some type of lending?
I do. I think that certainly this is a product that would suit them. When I talked about pension funds and that's what I had in mind as well. I think the difficulty is you still have to get the whole compliance conduct piece of this right, making sure that you're handling these customers in the right way. And that's not something that a big institutional fund manager necessarily knows how to do. But I think in the back end, in terms of providing the funding for these things, I think that is definitely a logical element. The other thing I've seen with super funds is they actually tend to be quite conservative. So they don't tend to want to get into new things. So I think this is a category that will develop over the next 5 years and become more legitimized. And then gradually, as the volume grows, you'll see more people looking at it as a logical place to invest their money.
Yeah, you can see that a lot at the moment with the there's a bit of index hugging conversation happening within the industry super fund world, where you're getting Goliath funds that are all basically investing the same, so everyone's becoming the same, right? And new ideas is everyone's scared of making those because they don't want to fall away from the index, right? So and then lose their customers, which is not great for innovation. What about sort of the one of the things we see as brokers, clients come to us with help from bank of mum and dad, and it's all a bit like opaque. No one's really telling, is it a loan? Is it a gift? Do I have to pay the money back? Because everyone's very concerned about, how that would affect bank lending. And absolutely it can do if it's a formal agreement, etc. But everyone's very also concerned around de facto risk and marriage risk, etc. And so What's your sort of take on that, and why your product really, elevates that conversation into a better way to protect the parents, really, and the kids, because it's all documented and it's very clear.
Yeah, you're making my pitch for me, which is great. Thank you. You have to be really careful when you enter into a bank of mom and dad situation. And that's one of the things we've tried to do. The 2B website has quite a lot of educational material on it to help people think these issues through. So different lenders treat these things slightly differently. We have found some ways. So at a high level, our recommendation, and I wouldn't call it advice because we don't give advice, and people should seek independent advice when they're doing these things. But our recommendation generally is that you should structure this as a loan, because I know you guys have this concept of the dumbo. The dumbo situation here is where well-intended parents give their money to their child who's, say, married to somebody else, and helps them buy their first property. And then a year later, the partner leaves and runs away. And because you don't have any clawback on that, the relationship breaks down and they've lost half the equity in the home, even though the parents have essentially provided all of that. So our view is that you should find a way to structure this as a loan. And there are a couple of ways you can do that, where you can make you can have effectively a zero interest rate, but make that interest rate variable in the event that the relationship breaks up, or those sorts, or the loan is callable in the event that the relationship breaks up, so that you don't actually have a cash flow impact for the borrower who's getting the mortgage. And the advantage of this obviously is that the borrower the first home buyer can come to the table with a 20% deposit and get a competitive no LMI interest rate home loan from you guys. And then, but because you've got this ultimate security, the parents have an ability to protect themselves. We also see that there's some advantages in this. You talked about risk as well. The standard way people have often tried to solve this problem is obviously through a guarantee. And I know there's a variety of different parental guarantee products out there, but at the end of the day, a parental guarantee means that I'm in a three-way relationship between my kids, the parent, and the bank. And I've got a situation where if the child falls over on their mortgage obligations, all of a sudden the bank is looking at the parent for that support. And our experience in the research told us that creates an uncomfortable psychological dynamic within the family, where you have the parent's house is sort of at risk as a consequence of the child's behavior. And so our view is that part of why we structure it the way we do is our relationship is purely with the parents. We give them recommendations and education about how they ought to think about it, but our view is it's your money, and we're looking to you. And then it's up to the parents effectively how they deal with their kids. And so you don't have the bank looking to the parents and this kind of subtle dynamic that goes on there, where the parents are wondering, asking the kids all the time, how are you going with your mortgage, and how are you going, and all that. It's, I don't know if you've ever lent any money to your siblings or family members, but it does create some interesting dynamics if you're not careful. So we think that's another advantage of this approach.
I've got another podcast, Your First Home Buyer Guide, and we interviewed a lawyer that specializes in these agreements, family agreements. Barry Frake, his name is. I'll put the link in the show notes if anyone wants to listen to it. And he talked about having the parents as a mortgagee. And so, but he did also say that some banks don't like having another mortgagee on the title.
They wouldn't. It just makes it more complicated.
Yeah. So I guess it is complicated is the first thing. And secondly, getting good advice around this. But and so that sounds quite interesting. So you mentioned earlier that a typical loan would be, say, 5-year loan to one of the to-be customers. How does that work in terms of, is it, like you said, sometimes the interest can be capitalized? Is it it's the same sort of, is there a higher risk interest rate as a consequence of being a different type of product? How does it sort of work in a I guess a nuts and bolts sort of sense?
Sure. So it's actually a really simple product. Think of it as a 5-year interest-only loan with the option to capitalize interest. That's what it is. And it's secured by a first mortgage on the person's house.
So you have to own a house outright in order to be able to do it.
At this stage, yes. So we started with a simple thing. Over time, we hope to introduce second mortgages and other sorts of things. But right now, that's the product. It's really quite simple. And so we give people a discount on the interest rate, 25 basis points off if they pay interest as they go. But they can choose to capitalize the interest and pay it all off at the end if that suits them. So, and that's basically how it works. And then at the end, so we go through, it's a very simple online application process, takes about 20 minutes. And then we conduct a video call with the customer to assess suitability, make sure they understand the product, understand what they want to do with it. We talk to them about how are they planning to pay that back. And we ask them to have 2 different ways that they're thinking about paying it back. And as long as that all stacks up, then we approve the loan pretty quickly, and we can settle the loans within 24, 48 hours. So it's really quite a slick process that takes advantage of technology to help us do what we need to do. So it works really quite well. And then at the question people always ask is, well, what happens at the end? And depending on the situation, what we've seen is a lot of people are planning to sell an investment property as a way to do it. We, in certain circumstances, we can choose to extend the term of the loan if the customer asks for that. If they have done a bank of mom and dad type situation, and as long as you've had reasonable growth in property prices, the math of it is that the children can actually refinance their home in 5 years and pay the parents back. And so that's a really neat wheeze, if you like, where you've got parents who are sitting in a house that's quite valuable. Their kids want to get on the property ladder. You take a 2B loan. The kids have the deposit. They can then buy a house. 5 years' time, they refinance, pay the parents back. The parents have actually had no cash flow impact because they've capitalized the interest. And the growth in the value of the home means that they can pay the parents back, and they now own a big stake in a home thanks to their parents' help. The parents haven't actually had to put out any cash. So it's a pretty neat little strategy.
It's assuming that the purchase from the children actually does go up in value.
Yeah, of course.
And that obviously is a huge issue, right? You know, a lot of first-home buyers, a lot of parents don't even know what's a good asset, etc. And Brian and I have spoken a different time regarding that risk, and that's one of the things we are very apprehensive in doing guarantor loans. There's lots of different reasons, but part of it's that, you know, the clients aren't showing any real great savings ability. They've just lived their life, and now all of a sudden they want to use their parents' equity to buy a house, so they haven't got that. And then also they're wanting to buy a poor asset, whether it's the investment or a high-density apartment, etc. And we're like, well, you're actually punting your parents' money here, not your own. And then you've got brothers and sister issues. You've got, you know, even just the relationship dynamic. One family's providing the guarantor, one's not. The other parents feel a bit like they're not part of it. So it can get really complex, the guarantor thing. And so a straight line loan, and the problem is parents sometimes struggle to get that, whether they've got to sell money out of their super fund, it's not a good time, or they've got to sell a property, and that they just are really cash tight. They don't want to lose 50 grand or 100 grand, right? But potentially accessing it. So there's definitely a sort of a market fit. Brian, I would love to sort of, you know, banks have all come out to take the conversation in a different direction a little bit. Banks have come out with a pretty good week, right? Some massive profits. Profits are up massively, you know, for lots of different reasons. What's your sort of take on the current banking, the banks, how they're performing, and sort of some of the headwinds, I guess, they've got coming in the years to come, and how they're positioned?
Yeah, so there's a couple things there. I think one is certainly rising interest rates have been helpful to banks' margins. But having said that, these margins are still a lot lower than what they were some time ago. And if you were to look at bank stock prices over the last few years, they're mostly down. They're not really, they haven't. So to say that they had big record profits, well, that's true, but that's coming off a period of declining profit that's now starting to turn around and stabilize. So I just think I look at it in a longer term perspective. If I look at the net interest margins of these banks, which is typically something that you focus on, those margins are running at about 1.7, 1.8% on their assets. That's probably 10% lower than they were a couple of years ago. So the margins are being squeezed. They have had, as I say, a bit of a benefit in being able to reprice their loans without having to reprice their deposits. And so that's allowed them some relief. But I think we're going to see more and more pressure on deposit margins. And so I don't think they're feeling overly optimistic. And they've also had to endure a huge amount of extra cost in resolving old regulatory issues. In the you think about the ones that have had wealth businesses that have had to do all that kind of disaggregation of their businesses. They've had huge restructuring costs. They've had all the pressures of COVID. They've had rising inflation on their supply costs. So I think they are doing better, but it would be probably pushing it a bit hard to say that it's all happy days. What we're seeing at the moment is a bit of a financially driven improvement because of the interest rate phenomenon and because tightening of the capital markets has meant that the banks that have big deposit bases are advantaged when it comes to lending. I mean, sure, you guys are seeing this with the non-bank sector, obviously has been having trouble getting funding, and that's put a real squeeze on their margins. So that's helped the big banks with their market share. But I think of that as a financial cycle-driven improvement as opposed to a fundamental competitive strategy-driven improvement. And that side of things is more challenged because there's a lot of new competition out there still. People's behavior is changing as a function of technology. Their expectations of from their providers are rising in terms of how good the service is going to be. The banks have been simplifying their businesses so they're not exposed necessarily to the growth that could come from, say, the wealth sector or the aging baby boomers or some of these other things because they've shed a lot of those businesses. So, yes, it's an improvement, but I view it as kind of a cyclical improvement. And I think the jury is still out on the more structural, strategic improvement and whether they'll be able to do that.
So, I mean, I absolutely, that's sort of was my take as well, is that, you're right. They've been able to take advantage of deposit holders to, lend it out in lending. But what do you think is driving this net interest margin down? Obviously, it's competition. Do you think that a lot of that to do with the broker success story in terms of, brokers, I guess, driving clients to the best deal rather than the consumer, playing on their apathy and just their having a Dolomites account, etc.?
I'm on a personal mission to help more people make better property decisions. And you can find out all about what I'm working on at veronicamorgan.com.au. And there you'll find resources for first home buyers, details about my buyer's agent mentoring program, access to suburb help for investors, or if you're looking to buy your dream home or an investment property in Sydney's inner west, eastern suburbs or lower North Shore, you can connect with my team at Good Deeds Property Buyers.
If you're thinking about buying your first home, upgrading to a new one, or purchasing an investment property anywhere in Australia, we would love to carefully guide you through this journey and importantly get the finance right. Please reach out via our website, wealthful.com.au.
Don't forget that you can download our free full or forecaster report. Which experts can you trust to get it right? theelephantintheroom.com.au.
I think brokers have certainly played an important role in price discovery through this period. But I think it's just competition. Think of it as we've had a period where a lot of money was pumped into the economy, both globally and domestically. That money ends up in people's deposit accounts, whether it's consumers or small businesses. That puts pressure on banks to lend it out because banks only make money when they lend, not when they take deposits. And so therefore you've had excess money in the system competing to try to write good loans. You've had players like Macquarie in particular saying, hey, this is actually a business we can compete in. We don't have to have a big branch network to play a role. ING is another example of that. You've had some of these more monoline players for the last few years have been able to grow quite aggressively because of relatively cheap funding that was available. That's driven prices down, and there's a lot of pressure. It's a bit of a long-winded answer, but big banks are very much compared by the stock market against each other, and the two things that the market looks at is margins and market share and mortgages. And so there's almost a slightly irrational focus among the banks on their mortgage market share and making sure that they're not being seen to lose out compared to their competitors. And so that's created a supply dynamic that has really seen those margins collapse. So the interesting thing will be to see what happens to prime mortgage margins from here.
Yeah, so interesting. Like, it doesn't need to be new players, right? The banks are all cannibalizing each other, right? Needing each other's loan books and compete. So there's four people. It's not just two players, right? There's four players competing against each other.
I'd say there's at least five, because I'd stick Macquarie in there, absolutely.
And so, and then everyone's worried about the clients leaving, and they're worried about the new business, and so that's really pushed. I mean, interesting. I've seen a lot of banks, even CBA, have come out, in the last 24 hours and said we're not going to do cashbacks. Do you think that the banks they've been basically writing loans under the cost of capital? I mean, that's what they've sort of been putting out in the media, and you feel like that game it's not sustainable, right? Because you're just going to continue to eat into your future profits, and it's not going to be good for your share price.
Yeah, I mean, I hate to sound like an old guy in all this, but I've seen these cycles in the way the banks are very. The focus on the share price for the banks means that they're very attuned to the narrative that's coming out of the equity analysts, and they tend to be quite cyclical in what they're worried about. They tend to get a bee in their bonnet about what's really important, and then that tends to drive activity. So for the last couple of years, there's been a real focus on who's winning and who's losing in terms of market share. And what the analysts are trying to do is say, of the four banks, which one should I invest in? I need to invest in some. So am I going to go for NAB now, or is Westpac advantaged, or is it CBA? And so for the last couple of years, they've been looking at market share movements and who they think is going to win in the market share side to drive where they invest. Now they're starting to say, well, actually, this is a bit silly. Who's going to have the margin? And so now the narrative is probably cyclically shifting back a bit to who's managing their margins well. And you saw, I mean, it's really interesting. There was coverage of the Westpac result that came out yesterday in today's paper that was giving them great kudos for saying, we're not going to be trying to win market share. We're going to stay in the market, but we're going to manage our margins well. And suddenly everyone's saying, yay, hooray, that's terrific. Well, a couple of years ago, they're getting beaten up over their market shares going down. So I just think this kind of, the narrative seems to come and go, and that tends to drive the dynamic on pricing. And so I think that CBA announcement was certainly a telling one, given their importance in the market. And it'll be interesting to see if the others take that as a sign that maybe it's time to focus a bit more on margin rather than market share.
Yeah, Macquarie been very against it, even pricing existing customers. Westpac, as an example, though, have been pricing their existing customers. Same with NAB, very, very competitively. So, if they've been existing customers and asking for a better deal, they've been offering them great rates, so they don't leave. Because what's your sort of thoughts on this? There's a lot of talk about the fixed rate cliff, right? What's your thoughts behind the scenes at a bank, been running the show? What's your thoughts about how a bank will do everything it can to keep people in their homes, and it's not in their interest to sort of, take homes off people, I guess, even if do you think that there's a bigger picture at play where APRA will work with the banks to, if anyone does get into, mortgage stress, higher interest rates over the next couple of years, that they'll be able to do things that they typically wouldn't have been able to do in other, cycles?
Yeah, so I think there's two different issues at play there. I think from a credit risk perspective about the issue of people literally not being able to pay their mortgage, certainly in my time, we have long had the view that the last thing we ever want to do is throw somebody out of their house, because it's just bad for everybody, including the banks. So as a general statement, if someone is trying to do the right thing and is in a temporarily difficult situation, the bank will work with the customer to try to resolve that. And the advice that I would certainly suggest that you should give to your listeners and anyone you come across is, if you are having trouble, that you really should call the bank, because they have programs typically to try to help people through these difficult times. But I think the other issue around this one is, I was chatting with the head of mortgages at one of the big banks just the other day, and I asked him about this, and he was completely relaxed about it because, and that didn't surprise me from what I knew, which was that actually for the last few years, the banks have been building up pretty significant buffers in the way that they assess credit. So you had assumed before you gave someone a loan that they could absorb a pretty significant increase in the interest rate that they were paying, even with the fixed rate. So you weren't lending on the basis of the previous fixed rate in terms of determining their borrowing capacity. You were lending on the basis that that rate was actually a couple 100 to 300 basis points higher. And so a lot of what we're seeing now says customers actually still have that buffer to be able to pay it. The other thing is that people have built up quite significant savings over the last few years. So those savings tend to also be associated with people who've got mortgages. So there will be exceptions, and there will be smaller segments of people who run into difficulty. But my assessment is that the ones who genuinely get into difficulty will be a pretty small percentage, and the banks will generally want to help them out. The bigger issue is more for the economy, that what this issue does is it squeezes out spending in other parts of the economy. And an interesting thing to point out is that is actually the point of what the Reserve Bank is doing. They are trying to slow inflation. They don't have a lot of levers. The best lever they have is to actually squeeze people's spending by lifting what they have to spend on their mortgage, ironically.
Yeah, it's interesting you say that, because going into this recent boom, you're right. I mean, we could still borrow at 7-8 times income, potentially, most around that 6 to 7. But if you went back to 2014, it could have been, 10 or 12 times, depending on the calculator, right? So it's lucky we didn't go into the higher interest rate environment if we had that run up in lending up to 2014, 2015. If it was still on those massive multiples, we would have even bigger price gains, but that people wouldn't have been able to cope.
Or perhaps those people might be the ones that might be most at risk then, the people that borrowed back then. No one's talking about them, and they might have more equity, but...
Yeah, most of those people have paid down quite a lot of their loans by now, is my experience. But yeah, I agree with you on that, Chris. I think the regulator deserves credit in terms of pushing the banks to be more conservative on that. And the banks themselves, I would think, there's a perception that banks are kind of cowboys and want to just lend irresponsibly. They don't. I mean, what you have is a genuine constructive discussion between the banks and the regulators as to what is the right point, what's too conservative and hurts customer service and the economy versus what's overly liberal and gets people into trouble. Everyone actually has this. My experience is people have the same objectives around that. It's just a debate about where to draw that line.
I mean, you are Mr. Wagyu, I guess. You were the guy that we covered this. We covered this quite a lot in this podcast. It was probably my number one news story back in 2018 that I was watching like a hawk, and waiting for everything I could hear in the media. Could you give us a bit of an understanding for our listeners of, the fight between Westpac and ASIC back in sort of 2018 and what happened behind closed doors and, and why that was such a big moment for the property market and lending in general? It was a huge case that rightly got a lot of media.
Yeah. So in simple terms, there was a debate about how much detail the bank needed to go into in analyzing a customer's expenses before making a loan and determining that loan was responsible or suitable for the customer. Westpac had taken the view that by relying on benchmarks around what customers spent on different categories, depending on who that customer was, their age and stage and the rest of it, that was in fact a not only sufficient but a better way of determining how much a customer could afford to spend on the mortgage. ASIC's view was, no, the customer has given you their bank statements, you must go through them in detail, and if they spent however much money on holidays, that's what you need to build into the thing. So our view was, in simple, normal human terms, well, hang on, fine, I might have spent that money on a holiday and, whatever, I've gone to Noosa last year, but if I've now bought a house, I will adjust my expenses so that I can make my mortgage payment. That is both just sensible, and it's also what experience told us. And but ASIC took a very firm view and effectively sued us and said, no, you're lending irresponsibly because you're not analyzing people's expenses properly. And our view and my view was, I'm sorry, I just don't agree with that. And so we fought the case in court. It was very painful because we went through a period for a couple of years there where the market was concluding that somehow Westpac's mortgage book was very risky and that we were being irresponsible. We were very confident that that was not true. But it was, as one of my colleagues used to say, when you're explaining, you're losing. So it was a very difficult time for us in terms of that perception. But ultimately, we won the case. And the reason you referred to Wagyu, the reason it's called the Wagyu and Shiraz case is that the judge in his judgment on this said, I might eat the finest Wagyu and drink the finest Shiraz every night, but when I take out a mortgage, I can get along on much simpler fare, I think was his line, which is actually quite a nice way of articulating the point that actually real people know that taking out a mortgage is a responsibility, and they tend to adjust their spending to suit that, which is why our view was, if you look at the benchmarks of what people need to spend on different categories, that's a pretty good indication of what they can get by on and whether or not they're going to be able to afford this mortgage.
And that's effectively what rising interest rates is meant to do to us as well, cut back on our Wagyu and Shiraz. And, it's like the case in point, current environment.
But why do you think that was why do you think that was so important though, Brian? Because a lot of people, if that went the other way, which, and ASIC won, which I'm not sure what their chances were anyway, but that's what really was causing the 2018, 2019 repricing to the property market. And when your case was solved, plus the election, plus rate cuts, plus APRA cutting, there was a multiple of positive things. But that was such an important case. Why do you think it was so important for just the whole Australian economy, really?
Yeah. Well, I think it would have led to an excess of it was already leading. You would have seen this. It was already leading to an excess of conservatism in bank lending policies, where the mindset, and this has been frankly a broad issue for banks over the last 10 years, that the mindset stopped being, I'm going to make a commercial judgment about risk and return and what's appropriate. And it started being, what's the regulator going to do to me? And how do I protect myself against accusation of violating the regulation? And so the mindset became all about, how do I make sure that I'm being conservative enough that I don't get in trouble with the regulator? Because if the regulator decides I've done the wrong thing, regardless of whether I have or not, I'm going to have a PR issue because the regulator feels they need to say everything publicly. I'm going to have the stock market get worried that I've got a problem. I might get fined, and so on. And so it has led to this real conservatism, gun shyness, whatever you want to call it. But in particular, and I think where, in addition to reducing the amount of credit that was available, it also made the process of getting credit incredibly difficult, because the banks had all these lawyers looking at the regulations. And one of the things I like to point out about banking is that banking, ultimately, most people would agree, is about judgment. That I assess someone based on character, I assess them based on their balance sheet, I assess them on these things, and then cash flow and so on, and then I make a judgment. But actually, regulators tend to look at things through the eyes of a lawyer, and lawyers don't generally do judgment. Lawyers do black and white. Lawyers do rules. And so what we've had is the imposition of a tremendous amount of very prescriptive rules about what banks need to do, what's okay, what's not okay. The consequence of that then manifests in long application forms, things timing out, needing to be redone, all these things that make the process of getting a mortgage much more difficult. Now, ironically, it's probably been a good thing for the brokerage industry, because brokers are the ones who can then say to their customers, look, this is going to be really hard, but I'll sort it out for you. So I actually think some of this has been good for the brokerage industry, because it's recreated a reason for brokers to play a role in these conversations. But I'm not sure it's the most productive and efficient way to get credit to the economy as to in terms of where it ought to go.
Yeah, I mean, if it went back down looking at expenses, everyone will be very conservative around their spending, right? The economy, just day-to-day spending. If I have to go borrow money, if they're going to look at my bank statements, I'm going to have to be really tight. And so if we went to that world, even borrowing money will be really difficult, because if they are overspending, they won't be able to borrow what they were planning to spend. So it was such a key. Even the property market pricing, it's property's priced on how much access to credit there is, right? And so as that access to credit got really tight, less buyers, property gets repriced down. So it was such a key case to be a part of, I'm sure. And I'm glad you guys got the win.
Yeah, thank you.
Not only that, but I mean, because of all of that activity, with the tightening up of lending, particularly to investors as well, and also the Banking Royal Commission, that all created effectively the longest downturn we've had in property prices since we've been tracking prices, right? So look at CoreLogic come out with those lovely charts that show the length and the length and the depth of any of our downturns, and that is by far the longest and most protracted. So, and I think the deepest, actually, the last time I looked at, I think we've just had one of the shortest ones, but shortest but steepest. I don't think we quite got that far. But that was a 2-year downturn as a consequence of this, I guess. Would you say it was a structural change, the way that banks went about lending money, and obviously had a real impact in terms of constricting access to credit?
Yes, it was absolutely a structural change, and it has profoundly changed the way banks think about credit and what they can provide. And not necessarily all bad, by the way. I mean, I think that I have a lot of sympathy with the Reserve Bank in wanting to be careful about asset bubbles getting out of control. Because they can do, and that can end up being quite painful. But if I step back from that, why do property prices continue to rise and be so resilient in Australia? Well, a big part of it is because we have a supply deficit. We've got, I think the figures are bouncing back to something north of 250 or 300,000 net immigration over the next 12 months. We aren't building that much housing. And so you have all sorts of things that restrict the ability of the supply of housing to grow to meet the demand, and that pushes prices up. And so when you do have a structural impost, like making it much more complex and difficult to get credit and restricting the number of people who are able to get credit, that limits, therefore, the ability to not only buy properties but build properties, and to address the supply side of this.
On the flip side, it also protects the market as well. I mean, you look at the US and the subprime lending situations, like the antithesis of that.
Yeah.
So
yeah. And so I don't think we should always be cheerleaders on just one side of this. We want steady growth in value that's driven by a nice balance between growing supply and growing demand, and we don't want that to get too out of kilter either way.
So I mean, you've got some friends at the RBA as well, which will just finally, before we wrap you up with Dumbo, what's your sort of take on their experience over the last few years, and the stories pre-rate increases, what they've had to deal with in the last 12 months, and how they're going to potentially play the rate pausing or rate cuts, like. What's the sort of insights into their mind, I guess, that you got from working with them, I guess?
I guess just two things I would observe. One is that they are not afraid, and this is fundamentally a good thing, they're not afraid to do what they think is right for the long-term health of the economy. And they are concerned about inflation getting out of control and wanting to make sure that that doesn't happen. And they've shown themselves prepared to lift rates to try to deal with that. And I just, again, go back to the thing I said earlier about the fact that unfortunately they have pretty limited tools to do that, which is why they have to focus on mortgage rates, even though what they're really trying to do is tamp down spending in other parts of the economy. But they're doing what they think is right. The second thing I would say, though, if I had a criticism, it's that they can be a bit on the academic side. The Reserve Bank is full of some exceptionally bright people, and they know they're exceptionally bright. And sometimes exceptionally bright people focus very much on data and facts, but maybe don't necessarily appreciate the nuances of psychology and how the market works and how consumers think. And that can cause them to overshoot one way or another. And so I guess that would be my observation, is that they probably waited too long to raise interest rates. And then my worry is that there's always the danger that they go too far.
Too far or hold them up for too high for too long.
I'm not too worried about where they're at the moment. I mean, I think they're predominantly doing a pretty reasonable job in terms of how they're playing the situation right now. But I think you could argue that if they had intervened a bit earlier, we might not be quite in this situation. But then again, they're not alone. I mean, reserve banks around the world have had this issue.
Yeah, I mean, we could see in 2021, right, the prices of properties were going absolutely bananas, not just in our capital cities, our regions, etc. And that's why APRA stepped in and increased the assessment rate, right? But ultimately, that was, there was signs of inflation around the world in January, right? And they didn't lift rates till, what was it, May? And, that's potentially when you could have really argued they potentially should have came in a bit earlier, I think. What's your dumbo for us, Brian? Have you, you've got a tale you can share with us that hopefully be a bit humorous?
Yeah, well, I don't know how it's only humorous when you think about how well, no, it's not really very humorous, I have to say, but it's again just some friends of mine who helped their kids buy their first house, and they gave their daughter effectively the down payment, didn't document it, and 9 months later, the husband ran off with his wife's best friend, and then went into a very difficult legal thing where he insisted that he needed half the value of the house as part of going away. And by the way, he didn't work as well. She was kind of supporting the whole thing, but he got half the house. And, it's just so avoidable and really unfortunate.
Yeah, I hate avoidable stories, and especially ones that aren't funny. Yeah, that's true. It, like you say, it is avoidable, but we all have great hopes when we make these commitments. And it's fundamentally one of the things that we talk about this podcast a lot is getting the right advice from the right people at the right time and making decisions with your eyes open. And that is one of those classics, that just to not just trust that things are going to be fine, but to get good advice, like you mentioned earlier on about getting that advice if you're going to go and lend your kids money or give your kids money or whatever. Well, Brian, thank you so much for...
That's a pleasure. I've enjoyed it.
It's been a great chat and very informative, and I hope our listeners have enjoyed it as well.
So do I. Thank you very much.
Thank you, Brian. Thank you for sharing the insights around the Royal Commission, the whole Wagyu case. It's very enlightening. And,
that's a pleasure.
Appreciate to hear your thoughts. Thanks for coming on.
That's great. And if your listeners could check out 2b.com.au, there's a lot of good information there for them.
Yeah, absolutely. In the with your bank of mum and dad, you're thinking about borrowing money. I think our advice to our clients is really having those real round the table conversations. Not only thanking them for the money, making sure you've got all the brothers and sisters on board. How are you going to get rid of this loan? What are you going to commit to? How are you going to keep the parents informed? Have some really deep conversations, document it all. 2B's got lots of great resources there because it's too late 2 or 3 years down the line and things aren't working out. Like you say, the relationship's breaking down. If that wasn't discussed, people start drawing lines in the sand. And I think it's a really good advice to be getting that advice.
We'll include the link in the show notes, Brian. And as I mentioned earlier, I'll also put the link in for that Your First Home Buyer Guide episode as well, because that also, I think we've got a download in there that's all the things you should talk about. But it sounds like there's great resources on your website, which I might check out for Your First Home Buyer Guide as well. It could be another conversation.
You can also go to the website and find out what your house is worth, which is quite cool.
Oh, no, that's one of my bugbears. AVMs, press a button. Oh, no.
Awesome. Thank you, Brian. Thanks for coming on.
All right, guys. Take care.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.